Welcome to The Explainer. Today, we're diving into something that quietly runs the entire global economy and honestly holds the ultimate key to your personal future. We're talking about the massive, often completely unseen world of pension funds. We like to call them the invisible giants of finance. But hey, before we get into the mind-boggling trillions of dollars in global markets, I actually want you to ask yourself a very personal and, frankly, kind of a terrifying question. What happens if you outlive your money? Just imagine reaching your golden years. Maybe you're unable to work, only to watch your hard-earned savings just slowly drain down to zero. That deeply personal, incredibly high-stakes scenario is exactly what we're going to be talking about today. That fear actually has a formal name in the finance world, and it's the core theme we are exploring right now. It's called longevity risk. Basically, it's the uncertainty and real danger of living longer than your savings can support, leaving you in a spot where you just can't maintain a decent standard of living in your old age. It's a completely universal human problem, and pension systems, well, they were explicitly designed to solve it. So here's our roadmap for this explainer. First, we'll look at the longevity risk, then the invisible giants of finance. Third, the mechanics of pensions. Fourth, we'll break down the three pillars. Number 5, a demographic time bomb. And finally, number 6, the future of your retirement. Let's jump right into section 1, the longevity risk, and how we've been preparing for the unknown. So people have actually been trying to manage this risk for centuries. All the way back in 1759 in the US, funds were set up specifically for the widows and children of church ministers. Then by 1875, American Express created the very first corporate pension fund. Fast forward a bit to 1940, and there were still only about 400 of these funds, mostly in railroads and banking. But notice the big modern reality anchoring our timeline here, the 2008 global financial crisis. That crisis was absolutely brutal. It wiped out a staggering $5 trillion globally. Worldwide pension assets dropped from 25 down to $20 trillion. In the US alone, retirement values plummeted by over $2 trillion. It literally forced countless people to postpone their retirement, take on second jobs, or drastically downsize their lives. The stakes here are just incredibly high. All right, let's move on to section 2, the invisible giants of finance and their massive macro impact. $70 trillion. Let that sink in for a second. By 2024, assets earmarked for retirement in the OECD are projected to reach approximately $70 trillion. That's a mind-blowing amount of money. Pension funds are now among the absolute largest and fastest-growing investors in the entire global capital market. They essentially act as these massive pools of what we call patient capital. They give the financial system deep structural stability and really help to significantly reduce short-term market pressure. So you might be wondering, why are pension funds so uniquely powerful? Well, it really comes down to a fascinating contrast. Think about standard banks. They deal in short-term liabilities, right? Like the cash you might suddenly withdraw from your checking account today. But pension funds? They deal in very long-term obligations. Their liabilities span decades. And this long-term horizon is precisely what allows them to confidently invest in things like long-term equities, bonds, and massive infrastructure projects. They're just operating on a totally different timeline than your average bank. Which brings us to section 3, the mechanics of pensions, how they actually work. Managing a pension fund is no joke. It means constantly juggling 4 massive threats. We already talked about longevity risk, that financially terrifying prospect of actually living a really long, healthy life. But managers also have to face investment risk from wild market volatility. Then there's inflation risk, which silently eats away at the future purchasing power of your money. And of course, interest rate risk, which totally affects how they value those long-term liabilities we just mentioned. Now, to help offset some of this intense pressure during your working years, governments step in. They offer tax-deferred savings. That means you don't pay taxes on the money until you withdraw it way down the road in retirement. It's a huge incentive to keep you contributing and keep the whole system flowing. And to fight those risks on the investment side, funds use what's called a life cycle investing strategy. It's brilliant, really. When you're young, your portfolio needs to be aggressive for long-term growth. That usually means heavy exposure to equities, often right around 75%, balanced out with 15% in bonds and maybe 10% in alternative assets like real estate. But as you get closer to retirement, that balance completely flips. The risk exposure drops way down, and the fund shifts heavily into bonds and safer assets for stability and reliable income. It's this continuous, decades-long balancing act between chasing growth and preserving your capital. Let's transition over to Section 4, the three pillars, and how we actually structure all this support. I want you to think of your retirement security almost like a building supported by three distinct pillars. Pillar 1 is your baseline state support. These are the public pension schemes provided by the government. Then you've got Pillar 2, which are the collective supplementary schemes, usually organized through your employer or maybe a specific industry group. And finally, Pillar 3. That one is entirely on you. Those are your individual supplementary savings plans. Working together, these three pillars are supposed to transfer your income across time, allowing you to smoothly maintain your lifestyle when you finally decide to stop working. Let's zoom in on that first pillar for a second, the public one, because it operates on a very specific and honestly highly sensitive mechanism. It's called pay-as-you-go, or PAG. Now, in this system, which is super common across Euro area countries, there is no giant vault somewhere holding your specific money. Instead, the taxes and contributions paid by current workers right now are immediately sent straight out the door to pay today's current pensioners. You're basically paying for a service way before you use it, completely relying on the next generation to do the exact same thing for you down the line. And that leads us to a pretty big problem. Section 5, a demographic time bomb, and this system's breaking point. See, the absolute crucial point of that pay-as-you-go system is the ratio of workers to retirees. Back in 1970, we had a really high ratio. Imagine a bunch of strong workers energetically pushing a cart up a hill, easily supporting the few retirees riding comfortably inside. No problem, right? But by 2020, that ratio totally plummeted. Today, far fewer workers are sweating to push a rapidly growing number of retirees up that exact same hill. The math behind the system is quite literally under extreme demographic pressure. And the crazy part is, this demographic pressure doesn't hit everyone equally. If you look across the Euro area, the variations are just massive. In some countries, the public benefit offers mere poverty protection, but in others, it can remarkably replace up to 80% of your final salary. The actual money saved up is highly concentrated too. The Netherlands has an exceptionally large share of these funds, closely followed by Germany. Meanwhile, countries like Ireland and Cyprus report mostly smaller funds. So yes, the safety net is vast, but it is deeply, deeply uneven depending on where you are. Which brings us to our final section, Section 6, the future of your retirement, and how the risks are shifting. Because of that demographic time bomb we just talked about, some really tough reforms are already underway. Governments are pretty much pulling every single lever they have to keep the system solvent. And what does that mean for you? Well, it means increasing your required contributions, effectively decreasing the public benefits you'll eventually receive, and extending vesting periods to strongly encourage you to retire later. Basically, you'll be working longer for less. They are also urgently boosting fiscal incentives for those Pillar 2 and Pillar 3 supplementary pensions. They're essentially sending a loud and clear message. The state is going to provide less, so you really need to save more. And as you do save more, you are going to encounter the single most crucial shift in modern retirement. We are rapidly moving away from defined benefit plans, where your future payment was locked away like a guaranteed treasure chest. Instead, we're moving toward defined contribution plans. In these plans, your final wealth is more like a paper boat trying to navigate the turbulent waves of the stock market. In a defined contribution plan, the money you put in is fixed, but your final payout, that depends entirely on how the market performs. Just look at how predictable the old world used to be. Under the old defined benefit plans, you knew exactly what you were getting. The formulas were totally locked in. Maybe it was a flat benefit per year of employment, or a payout based on your career average salary, or even a generous percentage of your final pay right before you retired. The employer, or the state, took on all the investment risk to guarantee you that specific, promised payout. But wow, in today's defined contribution world, the reality is starkly different. As the source material plainly states, future benefits fluctuate. These are variable income funds. All the profits, but much more importantly, all the losses on those underlying securities are passed straight through to you, the participant. So those invisible giants of finance, they're still out there, managing $70 trillion. But that cozy safety net of guaranteed outcomes, it is actively disappearing. Which brings us right back to where we started today. The demographic pressures are absolutely real, and the safety net of guaranteed benefits is dissolving right in front of us. All of that investment risk and that massive longevity risk we talked about at the beginning has been shifted squarely back onto your shoulders. So the ultimate question you'll really have to ask yourself is this: will your contributions today be enough to outlast your longevity risk tomorrow? Thanks for joining me on this explainer. Definitely take a close look at your own retirement math, and I will see you next time.